the 3 valuation methods that actually matter to buyers. You spent 30 years working in your company, building a $5 million business from scratch. Your entire retirement, or the majority of it, depends on this sale going right. But here's the problem. Most brokers, they default to the same cookie cutter approach on every deal, completely ignoring what the buyer is actually thinking. And when the method doesn't match what the buyer's perspective is, you can leave hundreds of thousands of dollars on the table, possibly even millions. I've been on both sides. I've sold 6 of my own personal companies. I've bought companies as a private equity investor, and I've brokered over 200 transactions worth more than $400 million in sales. What I'm about to show you is the gap between a traditional broker and what a sophisticated buyer is actually doing when they decide what your business is worth. By the end of this video, you're going to understand the 3 valuation methods that actually drive M&A transactions. And more importantly, you'll understand which method buyers will use on your business and why that really matters for your negotiation strategy. Valuation method number 1, discounted cash flow analysis. This is a method that private equity firms love because it lets them build up a worst case assumption to really drive your price down. Here's how they do it, and here's how to fight back. Let me explain what DCF actually means. It calculates your company's value by forecasting future cash flow and discounting them back to today's dollars. It sounds neutral, right? It's not. Here's why buyers love it. They control the assumptions. They get to decide what your growth rate will be, and they'll lowball it. They get to decide the discount rate, and they'll inflate it to account for risk. They get to build in every doomsday scenario to really make the math work in their favor. When does this method actually make sense? If you've got stable, predictable cash flow, think subscription model business or SaaS, a business with 90% recurring revenue, and really 5 years worth of clean financials, DCF, it can work. But for most Main Street businesses, you've got a customer concentration risk, owner dependency, market volatility. A sophisticated buyer will weaponize these things and they'll use it in the discounted cash flow method. I've seen private equity groups run DCF models on a service-based business and arrive at valuations 40% below the market comps. Why? Because they assumed the business was going to lose 30% of the revenue post-sale after the transition. Was that realistic? No, but it gave them negotiation leverage. Here's what it means for you as a seller. If a buyer leads with a DCF valuation method and your business isn't a cash flowing machine with zero risk, you need to push back hard and need to reframe the conversation around market comps and really precedent transactions. Don't let them control the narrative and make those assumptions. Because once you accept their framework, you've really already lost the negotiation. You're really arguing over which disaster scenario is most likely instead of showing them what businesses like yours are actually selling for in the market. Valuation method number 2. This is the method that actually tells you what the market is willing to pay for your business. Here's why comps are the only method that matters if you really want to get top dollar. According to PitchBook's 2023 US private equity middle market report, the median EBITDA multiple for lower middle market transactions, that's deals under 25 million, was 6.1x in Q4 of 2023. Now that's up from 5.2 just 2 years prior. That's a 17% increase. If your broker is using outdated multiples or industry averages from say 5 years ago, you're gonna leave real money on the table. Here's what comps actually are. You find businesses similar to yours that recently sold or publicly traded, and you apply their valuation multiples, like EBITDA or revenue multipliers to your business. This is really a market-based approach. It reflects what buyers are actually willing to pay right now for your business, and it's not a theoretical model. This is the most common method used in mergers and acquisitions because it's really grounded in reality. A buyer can't argue with the fact that 3 businesses like yours sold for say 5 times EBITDA last year. It's market data, it's proof. But here's really the problem that most brokers get wrong. They use generic industry averages instead of finding true comparables. They'll say restaurants typically sell for 2 to 3 times EBITDA, but they won't account that your restaurant is actually a Michelin star restaurant, owns the real estate, and has a James Beard Award winning chef. That's not a 2 to 3x business. That's a 6x business if you comp it correctly. My approach, I've got access to proprietary deal databases that will show actual transaction data for these type of businesses specifically in that niche. Not industry averages, not publicly marketed data, real M&A comps for the last 12 months. That's really how you're going to build a defensible valuation that will maximize your sales price. Now, when do comps not work? If your business is truly one of a kind, maybe you've got a patented process, or you're the only provider in a micro niche, comps break down because there's really nothing to compare it to. In that case, you might need to use a blended method or rely more heavily on precedent transactions. But for 80% of the businesses out there, comps are really the strongest negotiation because they're based on what the market is actually paying, not what some Excel model says. What real buyers with real money are paying for actual businesses like yours. Look, if you're sitting there watching this and thinking, I need to know what my business is worth. I need to know what my business is actually worth using the correct method, not some cookie cutter industry average. Here's what I'd recommend. We do a full business valuation complimentary. Normally we charge $3,000 for this extensive appraisal, but we give it to business owners that we think we can help. We'll run the comps, we'll run the precedent transactions, and DCF, if it makes sense, will show you exactly what buyers in your industry are willing to pay right now. And we'll tell you which method is going to maximize your sales price. No upfront fees, no obligation. If we can't add value, you don't have to pay us a dime. If that sounds helpful, there's a link in the description below. Click on it and let's figure out what you're actually valued at. Valuation method number 3, precedent transactions. This is the method that shows what buyers actually paid for actual transactions. And it almost always values your business higher than comps. Here's what precedent transactions are. They are actually prices paid for similar companies in recent M&A deals, not public market valuations, not theoretical models, real acquisition prices. And here's why this method yields higher valuations. Because it includes acquisition premiums. When a buyer acquires a company, they will pay more than fair market value because they're getting a strategic benefit. Maybe they're eliminating a competitor, acquiring a customer list, maybe they're gaining access to a proprietary technology, achieving operational synergies. That premium typically adds 20 to 40% to the valuation. So why are buyers going to steer you away from this method? Because it's going to cost them more. A buyer would much rather negotiate based on comps, which don't include acquisition premium, or DCF, which they can manipulate based on assumptions. If you let them control the valuation method, you're going to lose. Let me give you a real story with some of my own deals. I represented a manufacturing client with $13 million in equipment. If we'd used DCF or comps, the business probably would have been valued at say $8 to $10 million. But when we ran precedent acquisitions and highlighted the replacement costs of the equipment, we ended up selling for $14.5 million. The buyer was a competitor who wanted the capacity and the client list. The acquisition premium is what made all the difference. So what does this mean to you? If you've got strategic value to the buyer, and most businesses do, you need to anchor the negotiation around precedent transactions, not generic comps. That's how you can capture a premium. Because here's the thing, every business has a strategic value to somebody. Your customer relationships are valuable to your competitor. Your operational systems are valuable to a roll-up. Your brand, it's valuable to a private equity firm trying to build a platform. You just need to identify that buyer and frame the valuation around what they're willing to pay based on strategic assets. Valuation number 4, the asset-based approach. This is a method that most brokers, they won't even consider. It's the one that can add millions to your sale if you're in a capital-intensive business. Asset-based valuation method, instead of valuing your business based on cash flow or market multiples, you valuate it based on the replacement cost or liquidation value of the assets. That includes equipment, real estate, intellectual property, etc. So here's when to use it. It really makes sense when you've got a capital-intensive business where the barrier of entry is very, very pricey to get into. Think manufacturing facilities with, say, millions and millions of dollars worth of equipment in order to operate in that space. Say logistics companies with fleets of trucks, or businesses that own prime commercial real estate. Let me walk you through the $13 million manufacturing example from my own experience. I had a client with a manufacturing business that had $13 million in equipment. The business was profitable, but not massively so, maybe $1.5 to $2 million in earnings. If we'd used a traditional EBITDA valuation method, we probably should have valued the business at $6 to $7 million, maybe. But the equipment alone at a fire sale price was worth $10 million. And the replacement cost of the equipment was actually worth $13 million. So we used the asset-based approach and positioned the business as a strategic acquisition for competitors who wanted to increase their capacity without a 3-year lead time and really the capacity to outlay it for themselves. We sold for $11.2 million. That's double what it would have been worth using the EBITDA method. So why did most brokers miss this? Because they're really taught to default to cash flow multiples on every deal they do. They don't think like operators. They don't understand that sometimes the hard assets are worth more than the cash flow, especially in industries with a high barrier of entry. Now, when should you not use this method? Service businesses, agencies, software companies, anything where the value is in the people, the client relationships, or the IP, not the physical assets. In those cases, asset-based valuation will almost certainly undervalue the business. But if you're sitting on millions of dollars worth of equipment and real estate or inventory, and your broker is still trying to value this purely based on cash flow, you need to have a serious conversation about why they're leaving money on the table. Section 5, here's how buyers decide which valuation method to use. And it has nothing to do with accuracy. It's really all about leverage. Buyers will always push the valuation method that benefits them the most. If they're private equity and they want to lowball you, they'll run the DCF method with conservative assumptions. If they're a strategic buyer, they're going to lowball you. They'll use comps and they'll cherry pick the lowest comparable sales in the market. Your job as a seller, don't let them control the methodology. You need to come to the table with your own valuation using the method that maximizes your value. And you need to be able to defend it with actual data. And here's the negotiation tactic that most sellers miss. You don't just present one valuation number. You present a range supported by multiple methods and you anchor on the high. Let the buyer negotiate down from your best case scenario, not up from the worst case lowball offer. So what does this mean for you? Valuation isn't a math problem, it's a negotiation. And the broker you hire, they need to understand that and be exceptional at doing this. Honestly, most brokers, they've really never sold their own personal business. They've never been in the buyer's seat. They don't know how buyers think. They just run the numbers and they hope for the best. I've sold 6 of my own private companies. I've bought companies as a private equity investor. I know exactly what buyers are doing because I do the same thing when I'm trying to acquire a business. And that's the difference between leaving money on the table and maximizing your sales price. So here's what we've covered. DCF, that's a method that private equity is going to use. They're going to use it to justify lowball offers by controlling assumptions. Be ready to push back. Comps are the most commonly used method, and they reflect real market pricing, but only if you're using actual comparables, not lazy industry averages. Precedent transactions capture acquisition premiums and almost always value your business higher, which is why buyers specifically try to avoid them. Asset-based valuation is really a hidden weapon for capital-intensive businesses, where traditional methods, they're going to destroy value. And most importantly, buyers, they're going to pick the method that gives them the most negotiating leverage in the deal. Your job is to take back control of the conversation with data, leverage, and a broker who actually understands what's happening on both sides of the table.